Hello and welcome everyone to yet another episode of Chalo Numbers Samjhe. Real log, real money, real decisions. क्यों? क्योंकि numbers कभी झूठ नहीं बोलते. आज के जो हमारे गेस्ट हैं मिस्टर मेजजान डालिस, आज वो हमसे सवाल नहीं, आज हम उनसे सवाल पूछने वाले हैं. यूजुअली वी हैव पीपल हु हैव अ लॉट ऑफ क्वेश्चंस फॉर अस, बट एक्चुअली टुडेज सेशन इज गोइंग टू बी गौतम एंड मी, Gautam and I asking a lot of questions to Mr. Mezjan based on his experience, his understanding, his investment journey, because he's actually had a very different investment journey, a lot of ups and downs, lots of shifts, which I will let him speak more about. He's worked with IBM for a very long time, and post that he is now working as an investment coach. He's a certified investment coach. And has more than 25 years of experience investing in mutual funds. And one more thing that I got to know, he's invested his money across 180 to 200 mutual fund schemes, and that has taught him all that he knows today, right? With that, welcome Mezjan sir to our episode, to our channel. It's super amazing to be talking to you.
Hi, thanks Akshat. Glad to be here and thank you for this opportunity. Right? So, without much ado, we'll fire away. And of course, that wonderful introduction, of course, the 180 mutual funds is not a badge of honor. It is actually it is merely a statement of the number of mistakes made in the past. So that's what I always tell people. Very often I tell people that, I'm not a hotshot investor, but if all you do is learn from the mistakes I made and don't make the mistakes, you will be very far ahead in the game also. So
Yeah. Absolutely. No, I think for a fact now people have started realizing the more the number of mistakes they make, the more they learn. And in fact, I'll tell you something. I read something very interesting just this morning. It was something like, if you are told that after 1,000 mistakes you will actually reach your goal, then with every mistake you make, you will be more happy.
yeah,
Right?
that's a great one.
I mean, it was a great perspective. You just 900 left off reaching your goal. But yeah, I think that's what makes every thought special, right? So yes, I mean, and really excited for this. In fact, let me go ahead right and ask you, what about your investment journey? I know you are now very passionate and actively talking about index investing, that index investing is better than active investing. Or maybe let me put it this way, right? Index investing has helped you more than active investing, and so I would really kind of like to know how that has been. What's been your journey, and why index investing?
Sure. So I started investing in mutual funds in somewhere between 2000 and 2001. I think Franklin India Blue Chip Fund was the first fund I ever bought, right? And of course, I started like almost everyone else, right? I started by asking a friend who was quite intelligent even at that time. She was my batchmate and she was investing. Today she's in Google in San Francisco in a very senior post, right? So I said, smart person, if she's investing, maybe I should invest too. And she put me on to a mutual fund advisor, right? And I said, well, this is a circle of trust. This is a connection of trust. I trust this other person, and so let me go ahead. Whatever she suggested, I just started investing. I didn't know anything about mutual funds, but it was just based on trust, obviously, right? Like most of us do, actually. So that I started. Then I think I used to read a few little books in general about the power of compounding. I think I remember a book called Copycat Marketing that spoke about
Copycat marketing, that's an interesting name.
Yeah, so it talked about the tremendous impact of compounding. Of course, I had my PPF investment at that time also. So I had PPF, I had one LIC policy which I got suckered into, obviously, with somebody again who was known, and I had this Franklin Blue Chip and a couple of other funds that the person was recommending. Then slowly, when I got married, right, my brother-in-law and my wife's family were very much into investing in stocks throughout their life. My father-in-law has been investing in stocks for like 50 years or 60 years or something like that. So
Wow. Wow.
So he became quite a role model, and he kind of I was his real role model, and it was I wanted to learn a little more about it, etc. So his son, which is my brother-in-law was also into investing, and he was a mutual fund distributor, and he recommended this uh, website and of course magazine called Mutual Fund Insight to me around the year say 2004 when I got married, right? So when he recommended that, I picked up a few. I mean, I read a few which he gave me. Then I found, hey, this is really good. The content is really good. I kind of resonated with the content, and then I started, subscribing to that.
Mutual Fund Insight, is it?
Yeah, it is the magazine was called Mutual Fund Insight, and of course I subscribe to it till
Today
today.
also, I think it is available.
It's there?
Yeah, and till today I subscribe to it, right? So it's
Yeah.
been 25 years, and I
It's by value research only, right, Measure?
yes, correct.
Ah,
So it is
Okay.
a magazine from Value Research.
yes.
Right. So I became really interested, and I found that I was getting really glued every time the magazine would come. In those days, it was a physical copy. I would get so excited that I would sit and try to finish reading the whole magazine in the same day. And of course that was a foolish thing to do, but it's just indicative of the excitement level and enthusiasm. And so that is where my learning journey, started with reading Mutual Fund Insight and, looking at the data on their website and analyzing funds. So I tried to, create my own sort of analysis and pick funds based on my own analysis, etc., using the data. By then, I had left this mutual fund, distributor who had
Uh-huh.
started charging certain fees, right?
Okay.
But I was trying to analyze on my own, and I was picking funds on my own, etc. I would get very excited every time I saw a five-star fund or really good returns from a particular fund. I would create my own little Excel sheet with for 5, 6 columns and 5, 6 parameters I will take from value research and then try to aggregate them and give them some weightage and make my own formula and
Wow.
then try to select them, right? And select them, and then of course I would very excitedly go and buy those funds, and of course keep tracking, keep getting magazines, seeing how my fund is doing, and then after some years, I would find that maybe after 2 years, 3 years, I would find that my fund is not the fund which I selected short while back is not doing so well. So, in my enthusiasm and sort of being engineers and analytical people, right? It's natural for us to be gravitated, I think, towards doing data analysis and number crunching. So just the whole process of doing the data analysis and number crunching was sort of very fun, actually, I would say, to me, right? So I would like to figure out some formula and look at the data and analyze. So it's like a challenge, and you feel like you're achieving something. So I was doing that, but it was changing, and I was changing my funds. And yeah, and of course, I was managing my wife's portfolio to some extent. I was managing my mom and dad's portfolio after 2008. So I was constantly doing this, right? And I think I was learning, constantly reading Mutual Fund Insight. But finally, I kind of realized that every few years, the fund that was doing well was changing, and I was having to switch because fundamentally, I found that I could not hold on to a fund for more than, say, 18 months to 24 months after I found that it is underperforming, right? So some people, if they have the right temperament, I think that's great, right? If they can hold a fund for 3, 4 years, even if it is underperforming or starts doing badly.
Right.
But I simply could not do that. So I said, no, I cannot keep holding this losing fund. So now I have to analyze and find the next best performing fund. So I kept doing that. Then around the year 2010, I was just, I love reading and I love to go into bookstores. So I was in Pune, and I can't remember for what reason. As usual, I strayed into a huge crossword bookstore, and obviously I always go to the self-help section, and that's the section I love reading. So I looked there, and suddenly, there is this book on the top shelf that caught my eye, and it said "The Lazy Person's Guide to Investing," and I said, "Oh, that sounds like a book for me." Right? so I just pulled it off the top shelf, and I took it home and I started reading, and that is where suddenly this book started, showing me all kinds of analysis and research that had been done in the US. Obviously, this is a book based on data in the US, and it started showing that so many in-depth studies had been done that showed that when effectively that when active fund managers are actually outperforming the market, it is not based on real skill for most of them, right? It is based on more luck than skill, right?
Oh, that's a strong
And
claim.
these are really and it kept showing that the longer the time period, the more the fund managers fail. So like over a 3 year period, they will beat the index more. Over 5 year less, 7 year less, 10 year less, 15 years none, right? So that was the starting for an eye opener, and for me at least. So at least as I was reading it, that what I read really resonated. Like I felt like this is true. This is true. I mean, it may not ring true for everybody, but for me, it seemed like there is something really here. There is something I have to discover here. So I got very excited, and I bought. I immediately went and bought an index fund at that time in maybe 2011 or so, or maybe.
So an Indian Nifty Sensex fund.
Yeah,
Or
at that time there was a mutual fund AMC called Benchmark. It had opened. Benchmark was the first mutual fund AMC that opened, which started selling index-based funds. So I immediately found out that ye Benchmark is the thing, and Benchmark has basically the equivalent of a BSE 500 index fund.
Okay.
So I went and bought it, feeling very excited, and then I kept again reading, Mutual Fund Insight and other articles, and there were a lot of objections. There were a lot of objections that were being raised to the value of index investing. I mean, perhaps the most common objection that I was hearing was, Indian market is different. This is based on US market, right? Then there were, I can't remember all of them, but
That's which year? Sorry to interrupt.
around 2011 or 12, I would say, maybe 11, 12, right? So it was saying Indian market is different from the US market. Then it was saying, but the Nifty and the indexes are not properly constituted. There are all kinds of weightage problems in the index. That is why it does not apply. So, and of course, I got convinced. They were quite convincing reasonings, right? So I got convinced, and then I sold off my benchmark, BSE 500 index fund.
Index funds basically.
Yeah, so I sold it off. And then I was continued to do the same, sort of circle of activity of picking a fund or picking a set of funds, then monitoring its performance, seeing that it is underperforming after some maybe 2 years or 3 years, and changing and moving to another fund. Until finally, I think, maybe around 2016 or so, 2016, 17, yeah, I started feeling very strongly about moving to index funds, right? Because I could see this never-ending pattern. For me, it was a never-ending pattern of buying and selling, buying and selling. And while I was buying and selling, obviously now, after 2018 at least, we start getting capital gains tax also. So that is even worse. So I was getting very convinced, but then I got stuck with the problem of, I had a very nice financial advisor, mutual fund distributor advisor, and I had an extremely good relationship with him, and was really friendly, and he had really been very helpful, excellent customer service. So I was kind of, a little worried about how do I take out my investments from him. So that took me a while. But by then I also started reading these other books, right? So I think obviously the first book was
Is he
Lazy.
still a friend?
Yeah, we are still a friend.
That's a good question. Actually. Still a friend of ours.
I told him, I gave him enough, multiple years, at least 1 or 2 years of notice that I was planning to switch, and it was hard, but yeah.
I hope you didn't take away more clients from him.
No. No.
We moved everyone to index investing.
No. So then what happened? Yeah. So then I sort of really started reading after the first book, which was Lazy Investor's Guide. So Lazy Investor's Guide pointed me to other top-notch people in this field, right, in the US. One of them who was, we are going to talk about is Dr. William Bernstein, and then it spoke about another guy called Scott Burns, and then it spoke about this other guy called Bill Schultheis who developed the Coffee House portfolio. So then I picked up another book called The Coffee House Investor's Guide to Investing, and I read that, right? And then I read some of Dr. Bill Bernstein's books, and then I read, what was his name now? I can't remember.
There was another person, right? John C. Bogle, the Vanguard.
Yes. So yeah, correct. So John Bogle's book also. Yeah. So these are the fairly standard books. So I read them.
I believe even John Bogle talked only about index investing, right? I think
Yeah,
that's what.
John Bogle started indexing in the whole world, basically. Index
Oh, okay,
investing in
okay,
the world.
okay.
He's the founder of index investing across the world, and today Vanguard has $10 trillion of asset under management, right? So it's a very, very large asset management
And
company.
they do only index investing, right?
I think so. I'm not 100% sure, but I
Okay.
think so. Yeah. So I read all these books, one after another, and I got really convinced. But yeah, of course, there was the issue of, I have to leave my financial advisor, and yeah, I mean, of course, there is a huge sort of tax hit also that you take, right, nowadays when you
Yeah.
switch, because you switch and then you pay capital gains tax. But I kind of bit the bullet, and well, yeah, now that's the path I am on, right? I have. Yeah, I'm at peace. I mean, compared to the so many transactions that I used to do while I was, and the number of hours, maybe in a year I was spending a few hundreds of hours, at least hundreds of hours for sure, on investing in my portfolio. Now, I mean, I'd say it's under 8 hours per year actually, right? So it's a very, very low maintenance portfolio. I do less than 8 transactions per year probably, right? Buy or sell. So I think, yeah, that's
But if
been
I
my.
can ask, I mean, since the time you've like gone all in into index, what's been your XIRR or CAGR? A rough ballpark.
I need to look at it actually, but so little.
No.
I think before this crash, so if I look at I should have taken a screenshot actually of before the crash. So before the crash, it was showing around the 14% mark, I think.
Oh, nice. Oh, wow.
Equity,
That's
no, equity only, not including
ah.
debt, right? Equity only was showing around 14%.
Yeah, I know. I'm talking about only equity. I mean, so index investing into equity, right? So that's
Index investing only equity, yeah. If I mean, because my
because
debt
generally,
otherwise.
even while we're doing our assumptions and calculations, yeah, I mean, while we do the financial planning videos, etc., so we assume 12%, right?
Yeah.
And that is obviously we're assuming that we'll be diversifying it across various mid cap, large cap, flexi cap, so on and so forth.
Yeah, but that has been a dream run. So I mean, I'd say 14% has been the XIRR over the post-COVID. Post-COVID, it's been constantly up, right?
Right.
So even when other people look at such numbers, I always tell them that, don't expect this. This is a dream run, right?
That's a good point.
So
Yeah.
12, like you were saying, 10 to 12, is realistic, right? So,
Correct,
now.
correct. No, I mean, what I was trying to achieve, I mean, I was not trying to compare it with any of the active funds. I mean, that's data, again, that's a different topic altogether. But what I was saying is, I mean, just with index investing, it is very, very possible to achieve a 12 to 14% or even a 10 to 12% over a long
Yeah.
period of time. That's what I was like trying to.
Yeah. I think
Yes.
some of these people have done a lot of analysis, and Sensex and Nifty. Long term, they're saying anywhere between 10 and 12 seems to be the right number to that you can, and like index is Sensex. I mean, if you just do Sensex or Nifty, you should get that.
Gautam, by any chance, you have any idea what percentage would have mid cap or a flexi cap given in the same
More,
20,
much,
14?
much more.
Much more than.
Okay.
But that's
Much
the
more
point,
than
right?
But you have to compare it with large cap, not with.
Yeah.
I mean, index investing has to be compared with large cap.
No. So that's the thing, right? So when I moved to index investing, I made a conscious choice to use Warren Buffett's advice and stick to only large cap index. But a person does not need to be stuck to only large cap index, right?
Oh,
So
okay.
even till today, I am quite tempted to invest in a mid cap index fund, right? Although I have not done it, right? But there is nothing to stop you from saying, okay, 70 or 80% of my equity portion will be in Nifty 50, and 20 or 30% of my equity portion will be in mid cap 150 index. The only point is to stay in index rather than active. That was my take. So I
That-
think,
that-
Whatever the cap may be.
yeah, in whichever.
And I think that's a good point because a lot of times what happens is, I mean, especially, I mean, since I come from a non-finance background, for me, index का नाम सुनते ही I'm like, अच्छा ये
Large
Nifty
cap.
50 या Sensex 30, only
Yeah.
those are the two funds. But index investing could also mean, like, I don't know, क्या होता है, mid cap 50 होता है?
Yeah, mid cap 150. Yeah, so the
150,
so you
mid
can,
cap.
and in fact, I don't know. I really should have, but I took an extreme stance and I said I will not even go into mid cap, right? But today, if I had mid cap, I mean, definitely the mid cap index has generated. I mean, the general data I've seen is the mid cap generates minimum 2% more over a long term than the large cap, and maybe generates even 4% more. Yeah, I mean, that's one way to generate higher returns, of course.
So what we're ideally saying is, if a person wants, they can like just diversify their money. So a true index investor, can I put it this way, a true index investor could diversify their money between a large cap index, a mid cap index, a small cap index, and
Correct. Yeah. Yeah. Yeah.
and then based on their goals and based on their risk appetite, they can. Oh,
Yes.
interesting. But I really feel nice now. I don't know why, because मेरे दिमाग में इंडेक्स इन्वेस्टिंग में हमेशा सेंसेक्स 30 एंड निफ्टी 50 आता था. मैंने कभी सोचा ही नहीं कि अरे हाँ मिड कैप 150 भी तो इंडेक्स है.
Yes.
Yeah, similarly small cap as well. And do we have index for that? What do you call that? Nano cap? No, micro cap.
Micro cap. It will be there. It is there, but I don't think there will be any, funds offering, micro cap index.
Yeah.
So in Nifty mid cap 150 we have. Small cap again I'm not sure, but mid cap 150 index based in.
And what are these
schemes are there.
next 500 and all? They are also kind of index or no?
Yes, they are.
There is Nifty Next 50. There is Nifty 50 and there is Nifty Next 50. So those are the next, from the 51st company till the 100th company in market cap, right? So that is.
So then that's large cap only, because first 100 companies is large cap.
Yeah, that is large.
Second part of large cap we can say.
Yeah.
That is large cap, but a lot of the analysis that some people have done seems to suggest that Nifty Next 50 is almost as volatile, at least, as the mid cap 150. So it's not as stable or low risk as the Nifty 50. So Next 50 is significantly volatile, although it generates more returns also.
Yes,
More
correct.
volatile.
Asir,
Okay.
and this is pretty interesting, pretty different in my view, as to how did you go about it. But yeah, I mean, so how does today your allocation look like? I mean, are you, so I know you said large cap index majorly,
Yeah,
but
yeah.
how about the overall? I mean, what about gold, fixed deposit, and so on and so forth, like the overall?
Right. Yeah, so my allocation is, a little bit extremely simple perhaps. Yeah, I mean, so over time I became a great fan of what in the US they call the 3-fund portfolio.
Mm-hmm.
And I think it is a fund that probably originated from John Bogle or the Bogle heads, possibly.
Okay.
And so their fundamental analysis or their most simple portfolio suggests that you have only 3 funds. One is a local domestic fund, domestic large cap fund, which is like Nifty 50. The second one is to have some amount of international diversification, right? So I have chosen the US S&P 500 index for international diversification. And the third one is, of course, debt. In the US, they have very mature debt index funds, but here we don't seem to have. So my debt funds are, of course, split across multiple short-term debt funds. I do have some corporate bond funds as well, right?
I see.
So it's between corporate bond
So
and
percentage wise, if you can just give us a ballpark.
So my equity, so Nifty 50 equity is about 40% of my total portfolio. US equity is about 10%, and the rest 50% is debt. So effectively, I have a 50-50 equity debt portfolio now. Though I started very slow, I think I started at probably 30% equity. And have slowly built it up over, by using a SIP over around 10 years, I'd say. Yeah, around 10 years.
50% debt is like quite a lot of.
Correct.
Right. I mean, so generally, because I mean, for long-term goals, one would say you go more of equity. But what you're saying is you were more comfortable with debt and slowly, steadily.
Yeah. So I am an extremely risk-averse investor. I am extremely conservative. Right, and I think I have been again influenced by Dr. William Bernstein in this also, where I think, I don't know if I'll explain it clearly enough, but what he says when you take some risks, there are 2 possibilities, right? He says like 2 regret possibilities. So if you take a very high equity allocation and the stock markets don't do well for 34 years like they did in Japan, right? You could end up dying poor, right? Whereas the other option, he says, is, well, if you have a conservative equity allocation, you will only have the regret that you didn't become very rich, that you did not buy the BMW, or you could not buy the BMW. But at least you will not die poor, right? So he says you decide which of the two regrets you want. So I am on the conservative side that says I don't mind if I don't ever have a BMW,
Uh, I at least want my food.
or at least there is food on the table, so I am good if I die like that, right?
That's a good way. But एक चीज जो एकदम से मेरे दिमाग में आती है, and again I know different people have different studies here, but like all of these studies are done on global markets, and most of these writers, authors that you are also quoting that you've
Yeah,
learned
yeah.
about are everyone's outside India. अब how did you convince yourself कि ये सब जो भी globally चल रहा है, this will be applicable to India as well, and I am okay making this shift.
Yeah, I don't know about that actually. I'm not sure I know why or how I got convinced.
Tough question for Mejan. This one is tough.
I think
So basically out of syllabus question है.
Out of syllabus.
So I mean, my general belief is that, every country has its strong points. And I truly, while I do not necessarily like the US in every aspect, and in many aspects I do not like the US, I think that my personal belief is that the US indeed leads the world when it comes to finance, right? Finance, marketing, money, right? I think the US is far ahead. Their stock markets are far, far older. They do huge amounts of data research and analysis. They have, thousands of more data points for stock market data analysis than we do, because ours started only in, let's say, 1986 or something like that, right? And the US started maybe, yeah, for everything you have data from at least 1926. So they have at least, 60, 70 years more of data. And I mean, my belief is that human nature is human nature, right? The stock markets are merely a reflection of the greed and fear of human nature, humanity as a whole, right? I'm not really necessarily expecting it to be very different, in India than in any other country, because human beings, being human, continue to display similar behavior patterns. So that's my assumption, that they have lots of data, they have lots of research, right?
But what about the companies? Like, I mean, I'm just thinking the obviously, I mean, US has some of the biggest companies dominating the entire world. But I mean, let me think. Let me try to put my question in the right way. Like, जो इंडिया के कंपनीज हैं उनका ग्रोथ पैटर्न या the business or the business or the customer base, I mean, it said India itself has their biggest customer base and so on and so forth. So I mean, I'm just like kind of trying to ask you ki the kind of growth that US companies have seen over the years, how do we compare that to the kind of growth that Indian companies might see over the coming years? Because we're still like 10-15 years behind US in terms of development and being a developed nation, so on and so forth. I
Yeah,
don't know
so,
if I was able to put
so
my
you're,
question.
you're right. You're right. You're right that there is no way to project and say that both Indian companies and US companies will have a similar growth trajectory, right? So I think, but the only side point that I want to make there is that, based on a lot of my reading, what they say is that the real growth of a company and the stock market growth of a company have no correlation most of the time, right? So how the company actually does, because the stock market growth of the company is merely based on market perception,
Valuations and
right? It is market perception of the company and what they think will happen in the future, right? So, but that's a side point. But I think the other point that I want to make is that now that I have sort of been following a lot of Indian gurus as well, right? I mean, heads of AMCs in the mutual fund space, I see the same pattern. It's like I'm not doing anything different from heads of AMCs. Heads of AMCs are also constantly quoting US people who are their gurus and their mentors. So I'm saying I don't know any other way to get more data, more analysis, or more insights than the US, frankly, because they are not saying, okay, let's all follow only Junjunwala or something like that, right? All of them are quoting everyone who's from the US fundamentally for their analysis and their insights. So it's a call I've taken.
Cool.
And this underperformance thing, I think, when I was working with one of the financial advisor wealth management company, so the similar kind of research I did for when I was there with the company. So similar kind of research I did for in large cap space. So but that is like pre-COVID time, right? So I also observed there that large cap, most of the large cap fund managers, they are not able to beat the benchmark. But if you do the same kind of research now, data will tell you the different story because of the COVID. Because in COVID we saw something crazy happening, market falling like anything, and then the kind of recovery happened. That kind of recovery, it in both terms, what do you say? How fast it went up, right? And the quantum as well, right? So it went up like anything. So that kind of recovery Indian markets have not seen. So now in the current context, if we do the same kind of research, so it won't tell the story because of obviously COVID reason. But I think once this COVID thing settles and it is far behind us, and again if we do the same analysis, that whether this large cap or mid cap or anything, so have they been able to beat the benchmark or not? So I think large cap will again tell the same story. Not sure about mid cap or small cap. Because I believe that still, for mid cap and small cap companies, there is a lot of room, for fund managers to actively pick stocks there, right? But in large cap, it is going to follow the same path as US.
So what you're saying is, Gautam, you are of the opinion that so if somebody is looking to invest in large cap, category,
Yes,
then
you
it is
got that
better
right.
to go in the index route than the active route.
Index, that's what I, yes.
But mid and small, you feel there is still a potential that the active funds can outperform the index funds.
Yes, absolutely, Akshat. So for large cap, I do whatever in my portfolio or whatever I recommend is for large cap, right? Again, matched with goal, obviously. So in large cap, go for index. In mid and small cap, active funds you can still go with.
Makes sense. Makes sense.